typical transaction, the buyer may require 30 million of warranty protection, 30%, and if the seller's unwilling to provide that, they either face price erosion, or more likely they will face a smaller pool of buyers. Just running through what we've done recently, to provide an example, we had a transaction where it was a seller of a family business, and we were approached by a large investment bank who were aware of insurance and what it could do. And we structured a policy before they'd even started speaking to any potential buyers, which would provide the buyer with the protections they needed. And that allowed the deal to happen without the seller facing sort of significant price erosion. Run through the process of that here. Again, very similar diagram. We were approached by the investment bank. They said, right, we've got a seller here, we've got a target business, we want to achieve maximum value here. So we went to the insurance market, and even though we didn't know who the buyer was going to be, we received an indication for a buyer side policy. The seller knew from the outset how much this policy was going to cost and generally what it was going to cover. Once the seller had engaged the buyer, they were upfront about it. They said, we're not willing to provide you with significant protection here in the SPA, but we've got an insurance policy here which is protecting you to 30% of the transaction value. We, the seller, will pay for the policy, and you've got direct indemnification from an A-rated insurer in London. And it's amazing how often this process happens and how many buyers do become comfortable with the insurance policy, because yes, it's unfamiliar, it's not the normal protection that they would obtain, but ultimately it is more effective. You remove a lot of the counterparty risk, you more often than not have a higher limit of liability or a higher cap, and it's a very clear contract from an A-rated insurer.
Excellent. We've seen on the sell side, we've seen an interest in venture capital firms where maybe it's the last company in their portfolio in the particular fund, and they're hoping to push distributions back to the LPs. This insurance product can help them do that in lieu of a long tail liability associated with the rep and warranty. Have you seen that on your side as well?
Yeah, absolutely. We've put policies in place where, as you said, it's the last exit in a fund, and they know that in 18 months they're going to need to liquidate the fund and return money to investors. And often it is on the last exit where the insurance has most value. But that said, we're working with a number of funds at the moment here in Europe who are going through a divestment strategy. They know that they have to sell 10 assets in the next 18 months, and they know that in 2 years' time they need to liquidate the fund. They're structuring every deal with insurance. They're saying to potential buyers, look, you're not going to get any protection from us, but we're paying for an insurance policy here. It's giving you all the protection you need from an A-rated insurer. So yeah, very much so. We're seeing a lot of that activity.